Brinker International, the parent company of restaurant chains Chili's and Maggiano's, raised full-year guidance after stronger than expected same-store sales in its most recent quarter. Now, comparable sales improved across both Chili's and Maggiano's thanks to increased menu pricing and favorable item mix, though sales were partially offset by lower traffic, down almost 6% across both brands. The decline in traffic was largely attributed to a decision to de-emphasize virtual brands. But will the company's investment in consumer experience pay off? Kevin Hochman is the CEO of Brinker International. He joins us now. Thanks for joining us this morning, Kevin. So I want to get into kind of this de-emphasis on digital virtual experience. A lot of companies are leaning more into that. What's the rationale behind this?
Yeah, it's really about focusing on the core business. So we arguably have potentially the largest virtual brand in the world, and It's Just Wings. It's still only 3 to 4% of the business, so it's quite small. And we're spending enormous amounts of time, both operationally and with our marketing spend on it, when all that effort and time and money could be focused on the core business of Chili's. Number one, it's a much bigger business. It's 96% of our business. And then number two, it's a much higher margin. Most of the business we transact is in the dining room. We have alcohol attachment. We don't pay additional fees like we do to aggregators in the virtual world. So, it's been a decision that we made about 15 months ago, and we've been building back muscle. And the good news is the strategy is working. We delivered on the top line growth of Wall Street expectations. We had a huge beat on profitability, big part driven by this strategy. And then if you factor out the virtual brand traffic, we're growing traffic ahead of the industry. So we feel like we're very much on track. That's why we raised guidance. I think that's why you've seen the stock pop.
Kevin, I feel like Chipotle has their guacamole attachment rate. McDonald's has its fry attachment rate. What is the comparable for Brinker? And when you talked about the perhaps beverage or the alcohol attachment rate as well, how is that faring amid the consumer environment right now?
Yeah, Brad, we got to have you into a Chili's because we got a lot of signature items that are Chipotle's guacamole. So we've got our chips and salsa.
I'll come through.
Awesome. They're freshly fried every day. The salsa's made every day. It is our signature product. And then we obviously have our margaritas that people love. We're the number one margarita restaurant in the entire world. If we were a country, we'd be the third largest country selling tequila in the world. United States, Mexico, and Chile. So we have lots of signature items in our attachment. And, one of our big objectives right now is to continue to innovate on those things. So, for example, in margaritas, we've got our margarita of the month that, when Brian's on, he always talks about. And that's only $6. And then you can upgrade to our Presidente or other premium margaritas at $9. And then we now have super premium at Casamigos at $14. So we're going to continue to innovate on those things that we're known for because we know that's what drives guests in, and that's what's also going to drive check and profits.
And then, Kevin, I know I've seen your ads. We've all seen your ads for Chili's in particular. How much more do you think you're going to have to do when it comes to increase advertising to maintain traffic in your Chili's?
Yeah, that's been a big part of the kind of the turnaround narrative that we've had on the business. Number one was let's put the needed investments in to improve the customer experience, whether it's more consistent food, more consistent service, better atmosphere. And then number two, when we start working on that and start making real progress, which we've been doing, let's go ahead and turn on the advertising spigot so that we can start bringing guests back into the restaurants. And that's worked. So we were on a 3-year hiatus where we didn't do any television advertising. We made a big bet this year. We added an incremental $60 million into advertising, and we're about roughly halfway into our fiscal. And that bet's working. We're in October, we talked about it on our call yesterday, we're growing traffic ahead of the industry, even with the resignation of much of that virtual brand business. Profits are considerably up because we're focused on the dining room, and we're seeing that advertising build over time. So this last round of advertising that we did, we saw our highest lift than the previous two. So we think we got a lot of momentum with the guest, and our intent is to continue to build on that advertising over time as the guest experience continues to improve.
As you focus on the dining room, and of course that perhaps gives a little bit more focus around making sure that the expense costs on that dining experience also makes sense over time. Where does that prioritize the digital experience too? Because we've heard time and time again, quarter after quarter, where some of your competitors are leaning further into digital and trying to serve consumers who just want to order with the tap of a phone button and make sure that they don't have to leave their lazy boy.
Yeah, I couldn't agree more, and I think it's a huge opportunity for our business. We have a very big sales mix in off-premise, 28%. It's pretty much leadership in casual dining. We think we can continue to grow that by improving the experience. We have a huge opportunity both in the accuracy of our orders and the packaging of our food to really take it to a whole nother level. And so we have a cross-functional team right now working on just like we see the fast casual guys do and the fast food guys do. They have engineers and folks that are constantly thinking about off-premise because most of their business transacts off-premise, versus in casual dining, it was more of a bolt-on during the pandemic. And so now we're getting laser focused on how do we improve that experience, just like we've done with the dining room. And I'm confident within the next 12 to 18 months, we're going to see a significantly better experience for that off-premise guest, which I think will mean more business even beyond that 28%.